In the meantime, I will hold up Mark Blyth's book, actually Mark and Nicolo's book called Inflation. I'll be talking about this and they'll be talking about that. But while we wait another minute, I thought I would, flag the book because, well, I've been asked to. Mark and Nicolo's book. All right, we'll just give it another couple of seconds to let people get online. All right, so people will join as we get going. So let me start. Hello, everybody. Welcome to the Better Markets webinar on affordability and inflation, where we have a fantastic panel to discuss the question, what if we're thinking about this all wrong? And that question came to my mind as I was reading the terrific new book written by, as I said, Mark Blyth and his co-author, Nicolo Fraccaroli, if I'm saying it right, uh, entitled, appropriately enough, Inflation, and with the provocative subtitle of A Guide for Users and Losers. You really should read the book. It's very interesting. I'm not getting a commission, so that's an objective opinion. Before I begin, let me say up top, please put your questions in the chat and we'll try to get to them at the end. So throughout the commentary, please just put it in the chat and we'll look at them. Now, no topic could be timelier with the raging post-pandemic inflation, now markedly lower, but still not low, or is it? And what does low really mean anyway nowadays? Regardless of what it means to me or you, it remains among the top issues for American voters. And in fact, it may be a financial issue, but it's also to some extent an affordability crisis and arguably a political crisis. And if not a political crisis, certainly a top political issue. Um, Now, we are on the eve of many important developments. First, the Department of Labor is going to release the September CPI, the Consumer Price Index, tomorrow morning at 8:30. Even though the government is shut down and many very hardworking, nonpartisan career civil servants at the Department of Labor are not getting paid, they're nonetheless going to get the CPI out tomorrow. And kudos to them and the many other nameless, faceless civil servants who work hard every day for the American people, whether they're getting paid or not. And of course, the branch of the Federal Reserve that sets monetary policy, the FOMC, the Federal Open Markets Committee, is meeting next week on Tuesday and Wednesday, and they're going to announce their rate decision on Wednesday, which will be followed by the always incredibly exciting press conference with Fed Chair Jay Powell. So I thought today would be a perfect time for someone who has looked carefully at the facts, data, and history of inflation, and someone who, as a result, has some very provocative thoughts to talk about these issues, join us. And that's Mark Blyth, who's a co-author of the book. Joining him today for discussion will be Jared Bernstein and Deborah Solomon. Their full bios are on our website, www.bettermarkets.org. But let me just quickly say, Mark is a professor of international economics at the Watson Institute for International and Public Affairs, as well as the director of the Rhodes Center for International Economics and Finance at Brown University. Jared, who many of you know, is an economist and among many, many other things, is the former chair of the White House Council of Economic Advisors, and he's now a senior fellow for economic policy at CAP, the Center for American Progress. Deborah is the economics editor of the New York Times and has had a distinguished award-winning career covering everything from WorldCom and the 2008 financial crash to the pandemic and today's top economic stories. If you're not reading the New York Times and what Deborah's editing, you don't know what's going on. So I'm thrilled and grateful. The three of them are joining us today for this important discussion. Very quickly, a word on format. Mark is going to start with an overview of the key points of the book. He will be followed by Jared reacting to those comments, and the two of them will then be joined by Deborah for what I'm sure will be a lively discussion. Now, again, please put your questions in the chat throughout the discussions, and we will get to them at the end. And with that, let me welcome and hand it off to Mark. Unmute.
Look, Mark, you're muted.
Can you hear me now?
Yes, thank you.
That's all right. I'll start all that again. Technical issues, just when you think you've got them all solved. Thank you, Dennis, and thank you to Deborah and Jared for joining us today. Thank you to Better Markets for hosting this webinar. Now that I've got my camera fixed, I'll just not touch anything and hope it goes well. Thanks for coming today, for joining online. Happy to talk about the book. So let's get started and get stuck into what happened and why I ended up writing this thing. It's really my co-author Niccolo who is the impetus behind this. He was a postdoc that I had at Brown. We got him in just before the pandemic, and this is just when inflation was beginning to kick off. And Niccolo came into my office one day and said, "We should do a book about inflation." And I looked at him and said, "Why? Isn't this the most well understood story in the world? It's always and everywhere a monetary phenomenon, so on and so forth." And he said, "Yes, but both of us wrote books about the austerity turn in Europe 10 years ago. And the point that we both wanted to make was, at the end of the day, it's people at the bottom end of the income distribution that end up holding the bag. They're the ones that get squeezed when we have the reforms to get out of the banking crisis. And is there a kind of equivalent story for inflation? And it seems to be that there is, because the answer to inflation seems to be raise interest rates, cause unemployment, reset expectations, and then we move on from there. Is that really the only way to do it? Why do we think like this? And that got me interesting, got me interested, got me thinking about it, particularly about the distributional politics of inflation. And you often hear this phrase that we all suffer from inflation. And I just don't think that's the case. A very simple example of this is, if you're a single mom and you've got two jobs and you're trying to hold it together, a 10% inflation, even a 5% inflation, is going to make really, really serious choices for you and your family about whether you eat or not. If you're in the top 10% of the income distribution and you shop at Whole Foods, you're inflation immune because you've been overpaying for tomatoes for the past 5 years and you haven't noticed. So where you are in the income distribution really matters for how you react to inflation. And if you're at the top, you have financial assets that benefit when interest rates are raised, etc. We've known for a long time that creditors like inflation because it cheapens the value of debts, etc. So we wanted to just examine this kind of distributive politics of inflation and get away from this notion that we all suffer and we all have to do something about it. What also became interesting was the different inflation narratives that came along around 2021. Because rather than it being everyone dusting off a copy of Milton Friedman and basically saying it's the government spending too much money, that was just one of the stories that was out there. So to summarize very briefly, essentially there was the government spent too much money story. That was very much aimed, for example, at the Biden stimulus coinciding with the COVID shutdown and producing inflation. But there were over 30 countries impacted by the inflationary wave of the early 2020s, and only one of them had the Biden stimulus. So although other countries stimulated in different ways, many others didn't. And what became apparent, there was a big supply shock had something to do with this. Now, usually in stories of inflation, we look through the supply shock and we look for the fundamentals. Now, what does that mean? That means either you're looking at the monetary sources of inflation or you're looking at the labor market. And that became the second story, that ultimately COVID had shut down the labor market. People weren't coming back. This was combining with the supply pressures, and this is going to create an overheated labor market. And that's going to prompt the Fed to raise rates. That's going to then create unemployment. And we will reset expectations, as they say, that way. But then the narrative was contested again. Rather than this being a story of the 1970s and going back to the 1970s inflation, which those two first narratives would tend to suggest, we had a different story where it was more like the 1940s, that this was akin to coming out of World War II, and we have all these different bottlenecks and supply shortages, etc. And in a sense, this thing will pass. This became the so-called team transitory view. And then on the back of that, there was another group that came along and said, watch for corporations using this as an excuse to push on margins. So far from this being sort of one settled argument about it's always and everywhere a monetary phenomena, we became interested in the fact that this thing was kind of contested. There was no one authoritative definition of this. So we started to get into writing this. And the question we first started with Why do we always respond with interest rates? And part of that, again, goes back to the 1970s. That is to say, there's the story of Paul Volcker coming in the Carter administration. Inflation had gotten out of control in the 1970s. It was really a combination of very tight labor markets. That story is there, and excessive government spending. And ultimately, this de-anchored people's expectations. They begin to expect prices to rise. We get caught into what was called a wage price spiral, where wages push prices, push wages. It goes higher and higher. And Paul Volcker came in and shoves up interest rates to 16%, 18%. And this causes an enormous shock to the economy. There's a huge recession. But by 1984, it's all reset. It's morning in America. We get disinflation, and we get growth. And we began to wonder if we'd kind of misread the lesson of the 1970s, if this is what was going on. What prompted this was a paper I received from an investor friend called Michael Green, just at the start of the pandemic, contesting this notion that it was these, if you will, cost push forces of inflation and monetary forces that really caused the 1970s inflation. And the paper was authored by a very famous economist and central banker called Alan Blinder. And Alan Blinder, it turns out, has this whole series of NBER papers basically contesting that history of the 1970s. And his alternative account allows us, I think, to compare the 1920s and the 2020s and the 1970s, because otherwise we have this weird situation whereby the 1970s is all about a kind of monetary story of monetary expansion. And then that doesn't quite fit what happens in the 2020s. You basically have Europe runs out of gas and it takes them a year to find Qatar. That's a huge energy shock for Europe. And the United States discovers how incredibly dependent it is on global supply chains, which then shut off. And that seems to be the principal ingredients that drives this. So going back to Blinder's paper gave us a different way of thinking about it. And what was that different way of thinking about it? Alan invites us to go back to the 1960s and see it not as this inflationary cauldron caused by labor and excessive spending, but rather as a series of supply shocks. And the line we use in the book is, it's like the London buses model of inflation. And what I mean by that is, the famous phrase, perhaps, that in London you wait for a bus forever, it takes forever, it never shows up, and then 8 of them come along at once. And that's kind of Alan's story, is the 70s, that essentially you start off with Vietnam in the 60s, the funding for Vietnam basically being off the books, being very, very stimulatory. It creates very, very tight labor markets in the late 1960s. That does lead to those wage pressures and those cost push pressures. What also happens in this period is you get women and minorities incorporated in the labor market at scale for the first time. This is something Michael Green also stressed to me. And they don't come in as basically households in the traditional sense. They enter the labor market very much as consumers, and that adds to demand rather than adding to labor supply and having a depressive effect. On top of this, there were multiple failed crop harvests, commodity volatility, the oil shocks. So there was this whole series of individual supply shocks akin to the 2020s. Basically, we got two. We got global supply chains collapsing and Europe ran out of gas. Imagine that happening over and over again for about an 8-year period, all backing into each other and amplifying each other. And Alan basically says at the end of this, if you view it this way, ultimately it was dying out. And by the time that Volcker did his big shock and raised interest rates, it kind of did more damage than it needed to, because those expectations were already being set. The fundamental causes of inflation were basically falling in that regard. So that's a really powerful alternative story. And it began to make us think about the whole model of expectations that we have. The way we think about inflation is that there's a central bank out there called the Fed, or it might be called the Bank of England or whatever, and that people form expectations based upon the signals that come from the central bank. We pay attention to the credibility of those signals. That allows us to invest with confidence, and you have this whole story based upon notions of time and consistency and so on and so forth. And reading Alan's account basically made us go, is that really what's going on? So we started to look for empirical work that people had done on expectations. And we found that while there was lots of theoretical work that backed this up, there wasn't much in the way of actual hard data or experiments or other things. And what we found was actually the way that people tend to form their expectations really is definitely off model. It's not the same way that we think about it in terms of the if you will, the formal theory of all of this. For example, what most people take as the anchor for price expectations is the short-term gasoline price. Why? Because they gas up twice a week and it's emblazoned on the pump. So if that goes up, then they think that prices are rising. If that goes down, even if the rest of the economy's prices are going up, they tend to think it's going down. People tend to associate higher interest rates with higher prices rather than slowing down the economy. Why? Because when you push up interest rates of their debtors, their costs go up. They have to pay more. So if it's the case that this expectations mechanism isn't really driving how we think about inflation, how should we think about how best to govern inflation? Why should we rely so much on interest rates? Why should we rely so much on central banks? And we've got quite a bit of sympathy for the position that the central banking community got put in here, because in a sense, their only job was guard against inflation. It's why they kind of exist in their modern form, coming out of the inflationary crisis of the 70s and 80s, being given independence in the 90s in many countries, so on and so forth. And they kind of didn't do it. They didn't see it coming. And why didn't they see it coming? In part because we still think that inflation is always and everywhere a monetary phenomenon. But it wasn't. It was basically a series of supply shocks, and we kind of should have knew that if we'd taken Blinder's point seriously, that that's a way of thinking about the 1970s as well. So having done all that work, we basically went to two sort of things we wanted to explore. One was hyperinflations, right? When inflation goes hypercritical. And we basically did 4 case studies of this, looking at the German hyperinflation, Venezuela, looking at Zimbabwe. And what we ended up concluding in this one, and I'm happy to talk about this if this is of interest to anyone, is essentially when you have hyperinflation, it's because your entire state has collapsed. This isn't because the state ran the printing presses. The state basically runs the printing presses as the last resort because everything else has failed. So the story that we sometimes get, that if we have a little inflation, it leads to a little more, and then we all end up basically with wheelbarrows of cash, really just isn't the case. And then, of course, as the book subtitle talks about, who wins and who loses, fundamentally, how does that play out? And what we did was we basically went through the different cases and examples of this. Who in 2020, 2024, who won? Banks won. You probably all noticed this one if you have a savings account, because even if the Fed rate went to 5%, no one's savings account went anywhere near that. What's called the interest rate spread basically was captured by the banks. This became such a problem and such a political problem in Italy that the Italian government tried to do a windfall tax and basically grab that back. So banks definitely made out good. Who else made out good? Well, one might think about the example of Saudi Arabia buying Cristiano Ronaldo and all of his friends and setting up a soccer league, which costs a lot of money. Why would you do that? Because the windfall profits from carbon being short, given what happened in Europe, were absolutely astronomical. By one estimate from my colleagues at the University of Amherst, America's top oil producers had 220 billion in windfall profits in 2022. And some other interesting research on this, going back to the one about where was it really corporations, it was price gouging, etc. There is actually quite a lot of evidence for this. And in fact, the European Central Bank estimated that 40% of European inflation wasn't really coming from supply shocks from energy. It was actually firms in concentrated markets being able to push on past keeping their profits because of price uncertainty. So price gouging was certainly part of it. In closing, there was something that came up after the book came out, and I wish that we'd been able to incorporate it, which was John Otters, the financial journalist at Bloomberg, came up with this wonderful idea of how do we explain the disconnect that voters felt between what people like me were saying, this is the rate of inflation, and what they felt themselves, kind of the egg crisis, the disconnect between professional economy rates going down and people basically going to the shops and buying eggs and going, you're kidding me, what do you mean things are going down? And John had this wonderful way of doing this, where he took the way that the Fed looks at this is they survey 80,000 prices every month and then note changes in it, and then that becomes an index, and that's the index of all prices and determines if it's going up or down. And what they tend to do is strip out things that move around a lot, seasonally adjusted things. Strawberries are cheap in the summer because there's lots of them, they're expensive in the winter. Take that stuff, throw it out. Well, John basically took all the stuff that you don't throw out and created what he called the anti-core inflation rate, which turns out to be rents, fuel, food. If you're in the bottom 60% of the income distribution, that's kind of what matters to you. And what John showed was that depending on where you were in the income, the bottom half of the income distribution, your personal experience of inflation was far, far higher than the rates that we were talking about. And also, when economists are talking about the inflation rate, they're talking about the level of oil prices and how that's going up or down. But what people feel when they go into the store is the price level. That ultimately they went in and everything's more expensive, and it doesn't seem to be coming down. So when we, as a professional class, were saying, oh no, inflation's falling and eggs are still $11, they may have gone down to $9, but it's still more expensive than it was, and wages haven't risen. That's why this ultimately feeds into, as Dennis suggested, an affordability crisis and a political problem, that even if the rate of inflation has gone down, the fact of inflation has not. So I'll leave it there, and I would like to invite Jared to join the conversation now and tell us what he thinks about these issues.
Well, thank you very much. It's a pleasure to be here. I think you have. I'm not seeing me on your screen, but I hope you're hearing me. Here we. So I'm going to get started. Let me start by thanking Better Markets, whose advocacy for financial market guardrails is more important than ever right now. So thanks to Mark and all the folks over there. It is a pleasure to be here to briefly comment on this timely and stimulating, intellectually stimulating, not inflationary stimulating, and truly important book. I've been working on this issue for many years now with a large group of colleagues, and I'm going to insist that they all read it. I'm going to be quick so we can get to Deborah and the conversation. I'm going to make, I think, 7 points, which sounds like a lot, but I'm just going to read them, and they're just 7 sentences. So I'll get out of the way quickly. If there's any details we want to get into, we can do so. One, the most revelatory and powerful argument of the book is that for the most part, speaking broadly, but I think accurately, economists have one and only one way of understanding inflation. If Mark, Niccolo, and Milton Friedman were to talk about this, the conversation would go like this. Milton, inflation is always and everywhere a monetary phenomenon. Mark, actually, Milty, inflation in some cases, more rare than you think, is maybe kind of sort of a monetary phenomenon, but mostly not. Point 2. If the standard issue monetary and Phillips curve model that dominates doesn't explain inflation ups and downs very well, and more importantly, its shocks and some of the issues that Mark just took us through, then the blunt interest rate tool we assign central banks to use to control inflation, or as Mark and Niccolo might put it, to convince ourselves we're controlling inflation, is not just misguided, but prone to collaterally damaging innocent bystanders. And you heard Mark talk a little bit about that and writes about it under the rubric of the Volcker hammer. Point 3. Okay, if inflation isn't driven by what we think it is, what is it driven by? And here the book is challenging and perhaps to some readers almost disappointing because there's no single villain. There are instead a wide swath of unique forces that play different roles in different times. In that sense, the book isn't a whodunit. In fact, it's more of a who didn't do it, calling familiar suspects into the witness chair and finding them either not guilty or at least less guilty than you thought they were. Point 4, they do land with a bit more weight on 2 culprits: supply side disruptions, as I've mentioned, and excess corporate profitability, as Mark was just talking about. Point 5, they argue that the very commonly held notion that excess government spending is invariably, and particularly in the 2021 and 22 case, inflationary, is mostly misguided. And this is something that's close to my heart because I was there dealing with that in the Biden administration. Point 6, here I have what I hope is an interesting different or disagreement or slightly different view than the authors. I don't think that first of all, I don't think corporations were price gouging. I think that's probably the wrong word because it implies explicit collusion. And second, I don't think there's a great case for what becomes an important thing in the book called seller's inflation, which is this idea that corporates were raising prices more than their input costs demanded. And so this is behind Mark's discussion a second ago about how corporate profitability contributed to inflation. That's often called a seller's inflation because the sellers are leading to the inflation by increasing their margins more than they need to simply meet price increases in their inputs. But I think that I do think there's a case for this seller's inflation, this profit-driven inflation. I think there's a case for it, but I think it relates to high levels of fiscal support, and I hope Mark finds this interesting. Maybe we can get into it. The connection is through the way that fiscal support temporarily lowered the price elasticity of demand, which enabled, in ways that Mark and Nicola don't so much consider, it enabled firms to use the fog of the pandemic to launch the seller's inflation. By that, I'm talking about situations where firms could painlessly raise prices without any punishment in terms of losing market share because consumers were so flush with excess savings and fiscal support that they did not have the usual negative price response. The price elasticity of demand was very low. And that had to do with fiscal support, and it was one of the reasons why the seller's inflation could take off. So I hope you find that to be an interesting connection, Mark, and one maybe we can get into. Point 7 is my last point. Where do we go from here? This, by far, is the most exciting contribution of this book, and it truly is exciting to me. And I think to many others. The answer is we must go to a much more eclectic analytic place where we give ourselves as economists and analysts the permission and the degrees of freedom to cast a much wider net in our understanding of the forces behind inflation. Now, point 7 asterisk is that there actually are some things that we know help with inflation. I don't think, and I know Mark doesn't either, that we should throw our hands up and say, we know nothing. It's all just too arbitrary and random. There are some things we know that help. And one of the most important and timely, given the threats to this force, is a credible, independent Federal Reserve, which I would argue we have, but could be at risk of losing. With that, I want to bring Deborah into the conversation.
Thank you. This has all been very interesting, and I am seeing some of the questions in the chat, so do feel free to keep positing your thoughts there. Mark, your book calls for what you call a new inflationary playbook. You explain that the old one-size-fits-all approach to dealing with inflation, raising rates, is not going to work going forward, or not going to work as well, because the contributors to inflation are going to be less demand-driven and more from supply-side factors like energy shocks, supply chains, climate disruptions, labor shortages. You say that monetary policy alone is not enough. The solution requires coordination between central banks, fiscal authorities, industrial policy to address the root causes of inflation. So here's my question. How is this going to work? We live in an environment of severe dysfunction in Washington. We are in the 4th week of a government shutdown. There is a little bipartisan agreement on anything when it comes to fiscal priorities. So what is the prescription when monetary policy is really the only functional tool at America's disposal, at least at this moment?
Great question. Unfortunately, when you're arguing from an N of 1 and the N is dysfunctional, it's very hard to find a set of answers for that. In a sense, I'd have to magic up an answer that says, well, imagine things were a little bit more balanced. The only thing I can do in response to that is to talk about what other countries have done and to actually say, what do you mean by solving the inflation problem, right? So if we think about this in a narrow sense that somehow price expectations have gotten out of control and people think it's going to go up and we have to intervene to do something, that's why we needed an independent central bank, right? Yeah, maybe that's not the whole thing. I'll give you an example of this. This goes back to this story about how we think about inflationary expectations. When we looked for empirical work on this in terms of who listens to central banks and why they're important, the best piece that we found was a piece that was done by Bank of Spain economists and Santander Bank. And it basically looked at people in the financial sector. Somehow they'd managed to scrape the web of New Zealand. I didn't know you could do this. And then focus on the financial sector and then look at who passed around information from the central bank from the forecast. And they found you were hundreds of times more likely to swap a cat video than an inflation forecast, even if you worked in the financial sector. So maybe that's not the mechanism, right? So let's let them off the hook for a minute. Maybe they're not the only thing that can be done. Then the question becomes, what's the problem you're trying to solve? If it really is, for example, just different types of supply shocks, they will pass, they might not, depending on how you respond to that. But there are ways of cushioning things which are quite interesting. Spain had a really good example of this versus Hungary. Hungary came in and said to the supermarkets, right, prices are getting frozen. And as exactly textbook economics would predict, it was a total failure, created a black market, didn't work, right? Bad idea. What Spain did is they came in and said, okay, if you're in the bottom 40% of the income distribution, this is going to hurt you more than everybody else. We can't solve the inflation thing directly. We don't even really have our own central bank for a start. How about we subsidize your consumption? How about we subsidize your electricity bill? How about we subsidize your transport costs? And what I'm doing is I'm taking one part and giving to another. And it's a redistributionary set of policies. If you care that basically the bottom 60% are the ones that bear most of the cost of inflation, both in terms of rising prices and unemployment risk, then the policy solution is actually less to do with what's the optimal interest rate. How do we get these people through this moment? Right? That's not a conversation we're equipped to have here at this moment, unfortunately. But I think that's how we should be thinking about it in general. What's the inflation problem you're trying to solve? Is it the numbers themselves, or is it the effect on particular parts of the distribution? And I would say that we should focus more on that, because if we're worried ultimately by people's anger over inflation and the inability to do it, doing nothing to change that distribution, that's part of the anger and part of the problem.
Deborah, can I give a quick answer to your question?
Please.
Very quick.
Yes.
So this may surprise you, but I actually think that that supply side solutions are more nonpartisan than demand side solutions. So right now, nobody's doing anything and the government is absolutely a mess. So like if we stay where we are now, we're toast, and that's pretty simple. But you know, this is an extremely harsh disequilibrium, and I don't think we can stay here for too much longer. So imagine sort of normal pre-Trumpian politics, which I hope is post-Trumpian politics. It's very hard to get conservatives to do anything to help, folks on the demand side, people who've been left behind and all that. It's not that hard to get them to do infrastructure, to build things, to have tax credits to build things and so on. So that actually could be a political feature, not a bug, in the framing of your question.
Yeah, absolutely. And ultimately you want to do is you want to adjust the supply side anyway. That's where you want to get to. And I have an example at the end of the book, which I was very happy when I thought of this one, because it exemplifies this perfectly. If you ever go to Denmark, which is, every sort of center-left person's version of a paradise on earth, one of the things you'll notice is that everyone rides a bicycle. Now, the interesting thing is they didn't used to do that. They weren't like the Dutch. They weren't actually a bike culture. But when the oil shock happened in 1974, the government got out and said, it's costing a fortune. We need to reduce our consumption. It's killing our balance of payments. Can everyone get on a bike? And they kind of did, and they stayed on the bike. And in doing so, they massively reduced how much oil they needed to import. So just that action itself is a great example of, ultimately what you want to do is change the supply side so that you're no longer vulnerable to those shocks. So, that's why, for example, again, if we think about investment in EVs, right? If you're invested in EVs, yes, you still need to make electricity. Yes, a lot of it's still made from fossil fuel, but it's very different from putting it in your tank. And if you have a shortage of oil and gas, or it becomes hyper politicized as it is in the moment, these are going to be more inflationary factors. So if you can get rid of those things, change the energy mix, all of that's good for basically disinflation.
Well, so I want to talk a little bit about, the latest inflationary shock, and I'm glad we have Jared here. So obviously, we had the American Rescue Plan. I know there's been a lot of discussion about the fact, how much it contributed to inflation. And I know, Jared, that you yourself have said, that it did contribute some. So we had that. But that also did have tax credits to help people, the child tax credit, and it was capped for people who, at a certain income level. And then we had, obviously, all the Ukraine stuff happening, but we did have industrial policy. We had the CHIPS Act. We had infrastructure. All of that was aimed at diversifying supply chains. President Biden, communicated about the causes of inflation a lot. I mean, he was very emotive about it, which is one of the things that, Mark, you say in your book is important. So why wasn't that enough? I mean, the Fed still had to raise rates.
You mean enough in terms of how people felt about it, or enough in what enough in terms
Enough
of
in
what?
terms of both, well, the feeling, but also just the fact that it took so long to get inflation back down to where it is now. I mean, we went from 9% to, we were at 5, for a while, it seemed like it wasn't budging. And
Yeah.
you can argue with me, and I would like you to, do you think the Fed's, raising interest rates did help bring down inflation, or do you think it was the other factors that I mentioned? I just wanted this the case study for Mark's.
I could write my own book responding to that question, so I'll try to be brief as best I can. So yes, by the way, people at the time were saying that inflation may be transitory, but it's transitory.
Right.
It stretches out, and I actually think that's pretty accurate. That's where Paul Krugman eventually landed. I think that the easiest part of your question to answer, why did it take so long, is that that's just how long it took for the supply chains to become linked back up again. And that the disruption from the pandemic to global commerce was something we hadn't seen much of before. And actually, we tracked this super carefully. When we started seeing the containers come off the ships, and into the ports, and they were stacked way too high. We had this throughput was really low. We were tracking that you can track that on a daily basis. I was actually watching containers going in and out of ports on my morning data sheets. As soon as that started improving, inflation started to ease and then started coming down. So I think it's closely linked to that part of the answer is closely linked to just how long it took for things to come back online. The labor market was also lastingly disrupted. The labor demand was way ahead of labor supply, and that was because a lot of people were out of the job market and didn't come back in. In fact, we were worried about early, what did we used to call it? I forget there was a phrase for it, but early quits, or people were the do nothing society or something. And a few months later, people were coming back in. So that doesn't strike me as particularly mysterious. In terms of the thing that I think is most interesting is something that Mark touched on, and economists are not very versed in talking about this issue, which is price levels. Mark was correct when he said one of the reasons people were very unhappy about it, about the inflation, wasn't so much the inflation, it was the price level. So, and it's even worse than what Mark was saying. Mark was saying, well, your eggs were $11 and now they're $9. You're still pissed because they used to be $4. We were going out there when I was in the White House. We were going out to what we call WHNL, White House North Lawn. That's where we talk to the cameras. We were going out there and saying, good news, inflation was 9%. Now it's 3%. And they're like, oh, so my eggs are 11, but they're going to be like 11.50, and I should feel good about that because instead of being 11.50, they're not going to be 12. So people were they remembered what their old prices were, and damn it, they wanted them back. And that was really big.
Mark, what's your thought about what do you think should have been the playbook after the 2021 price shock?
So the 21, we have to put this in the context of COVID, right? And, we're all Monday morning quarterbacks. It turned out not to be as serious. We spent a lot of money, blah, blah, blah. It could have been the Black Death. Like, nobody knew. So if you were any responsible government and you didn't take maximum effect, then, that was it. Then you get slammed with the supply chain shutdown. Your colleague, Peter Goodman's book, How the World Ran Out of Everything, is the single best account of this. And there's wonderful stories in there about shipping companies basically making sure that things didn't appear at the right time and all this sort of stuff, pushing on prices, shall we say. So what we did was but I think one of the tactical problems was calling any of this stuff stimulus checks. These were compensation checks for the fact that you sent 80% of the labor market home. If you hadn't have done that, the drop in demand would have been absolutely catastrophic. And in terms of its inflationary impact, if you go to the New York Fed Survey of Consumer Finances, which tells you what people spend their money on, after they got the first set of checks, it was the largest ever increase in credit card receivables. In other words, everybody just ran up the credit card and used that check to get rid of the credit card debt. That is inherently non-stimulatory. So when you put all that together, it tells me that governments everywhere were in a rock and a hard place. They didn't know the extent of the supply shock that we're going to get from the COVID supply chains breaking down. There may be an inflationary effect of the fact that we chucked a couple of $1 trillion in the economy, but that's against the background of shutting down 80% of the labor market. I mean, all things considered, I think that we did quite well. When you don't actually end up with either runaway inflation or massive unemployment, they did relatively well, it has to be said.
Let me just challenge you for a second, because the Fed did raise rates over 5%, and there were a lot of Democrats, like Senator Warren, saying the Fed should cut. It was hurting the labor market, but it didn't hurt the labor market. Unemployment stayed relatively low, and wages went up. So what was wrong with using that hammer in the wake of this type of supply side shock?
Because it was a rock hammer. This wasn't Volcker's hammer, right? If you think about it from the point of view of the ECB had just presided over a decade of incredibly low, if not negative growth, deflation in the periphery, belt and tightening that ended up causing more debt rather than less debt, a really bad policy mix. They'd got people excited about green central banking and then immediately backed off from that when it became real. They were sitting in, let's say, Malheur. The idea that they were going to do a Volcker shock on their populations, they would have burnt the building to the ground. There was no way that was going to happen. And in fact, not one of the major central banks actually put their policy rate above the actual inflation rate. They tracked it. So if that's the case, the notion that this was singularly responsible for, like, the happy ending, the happy landing, I should say, I think scratches credulity. So I think that, as a whole of government project, we didn't manage it that badly, but the idea that raising interest rates to 5% was the thing that really made that happen, I am quite skeptical of that. I think it's the natural decay of the supply shock, the eventual adjustment in the supply side, and monetary policy played a supportive role.
Yeah, Deborah, I would agree with that. And I think, the way I heard your question, Deborah, is well, or at least the way I would answer your question is, not simply did it help or did it get the credit? I agree with the way Mark just addressed it, but like, was that a mistake? And did it hurt? Did it hurt more than it helped? And I actually think that it made sense for them to do what they did, for them to raise when they did and as much as they did. But that's in no small part because I'm still a bit stuck on this issue of inflationary expectations, and I don't want to get in trouble with Mark. But I think that at that point, the Fed had to show that they were concerned about keeping the inflationary anchor, and what they did was a good compromise in terms of doing that without going, full Volcker.
Mm-hmm. So I want to ask, obviously the reason that the Fed kept rates high was because they had a target. In 2012, they put in place a formal inflation targeting of 2% over time, consistently undershot that goal for years, to your point earlier, until the inflation spike. So I have a question. Should the Fed have an inflation target? And if so, should it be higher than 2%? Mark, do you want to talk about that?
Yeah, I'm a little skeptical on targets in general, including fiscal targets, because these things make sense when the world's really calm. Because if you've had a target and things aren't very volatile, they're not going up and down, you can probably hit the target, right? It's not that difficult to do it. But when you're hit with much more volatility, you try and hit a target and then you don't hit the target, and then you lose credibility for having the target. And this is a situation which I think the British government in particular finds itself in at the moment, whereby they have fiscal rules, but because the economy has been hit by low growth and many different types of shocks, they're simply unable to hit their targets. So then what do? You change the targets. And at that point, you're not really in charge, right? You're basically playing this numbers game with targets. So I'm quite skeptical of them in general, because it also relies on the notion, without getting too wonky on this, of this thing called the natural rate of interest, which is out there in the world, and we can uniquely target it, and if we hit it, then everything goes happy land. I just don't think that's really how it works out. I think a lot of what we're doing is kind of relying on models that were drawn up when the world was growing fast, relatively speaking, and there was less volatility, the so-called, that golden age that Bernanke talked about. And these models now, they're not useful. I don't think they help us understand the world that we're in.
Jared, what's your view?
I'm very sympathetic to Mark's response, and I really do think the book is essential reading in precisely opening up these kinds of discussions the way Mark is doing. I think the target's important, and I'm for it. So I have a different view, but I totally respect where he's coming from, and he may be right. And certainly, the examples of chasing a target are negative. But in our case, I think it's really, really important for the Federal Reserve to be able to explain to people, to markets, to investors, to politicians, what they're trying to do in simple and clear terms. And I think having a target makes that a lot more doable. And I think having the absence of a target, and this is something Mark, I would challenge Mark in his response, the absence of a target leaves you much too wide open for all kinds of buffeting from all kinds of sources saying, why don't you do this? Why don't you do that? When the response can be, oh, because I have to hit my target, that's why I'm doing what I'm doing. I think it's a really important organizing device for Fed communication as well as Fed policy.
Do you think 2% is the right level?
Yeah, I'm comfortable with 2%.
So I want to bring us to the present, and I know there were some questions in the chat about this too, but obviously we are now in an environment of a high tariff environment, or at least more tariffs than we've had since the 1930s. We will, as we've mentioned, get CPI tomorrow, which maybe will show us a little bit more about where the tariffs have shown up. This, I would presume, falls into this side, the silo of supply side shocks. Obviously, we're also potentially going to do more tariffs on China. So far, we haven't seen that much inflation from President Trump's tariffs. We've seen it in certain places. There are categories of products that are taking a hit. But can you talk a bit about how you view tariffs and what is the economic, approach when and if tariffs do start to raise prices? Is that a moment when you think the Fed should intervene with higher rates, or is there some other alternate approach when you have import taxes that are, going to hurt people on the lower end of the spectrum more than anybody else? Mark?
So the Fed did a study in March of this year that basically said, how do we think this is going to shake out? Is it really going to show up in prices? And they came to the surprising, but I actually think good conclusion or intuitive conclusion that what you're going to see is investment in the countries that do exports to you will fall as much as this is going to show up in prices. The second thing is substitution. Trade goes somewhere else. China decided before we even tariffed them that they were going to be less reliant on the United States, and the rest of the world has been absorbing their exports. Now, that could create its own issues, but that's that. And we have this thing that we all get in Econ 101, the so-called ceteris paribus assumption, all things remaining equal. Well, the thing is, nothing ever remains equal. And when you have something like a tariff shock of the United States bringing in effectively a 20% tariff rate, or 18% as it is right now, this is a big shock, but it doesn't work uniformly. The exchange rate's going to take some of the hit, suppliers will take some of the hit, supply chains will take some of the hit. And, does it feed through at the end to tariffs? Well, it hasn't done so far. The system has largely adjusted. If we go to 30%, you basically stop trade, right? And then things that you need that you get from someone else will get ludicrously expensive. But just now, it doesn't seem to be going the way that we thought. A second thing that's become interesting is how this has gotten tied into the treasury market. Because after doing the tax cuts, of course, you'll remember people were getting very nervous about the sustainability of debts and deficits. Then they started to look at, well, hang on a minute, you're getting 30 billion a month in the door. That's 300 million a year. That's 3 trillion over 10 years. That's the tax cut paid for. And what I think is very interesting is that regardless of which party's in power, if you're getting 30 to 50 billion a month in the drawer and you're a politician, you're really going to give that back?
Well, I guess, Jared, I want you to answer the question too, but
Sure.
I am curious whether you think this plays into your idea of seller's inflation and whether companies already had gotten, consumers inured to the idea of higher prices.
Yeah. So I think what I said about seller's inflation before and the price elasticity of demand, consumers' low responsiveness to price increases back then, that's off the table now. They're back to high responsive.
Mm-hmm.
And so that's changed. And so that's one of the reasons why we see profit margins from some of the sectors where they were elevated have come down quite a bit, particularly groceries. I don't think that it's hard to generate a seller's inflation when you have consumers who are quite responsive to price increases. And so that's one reason why we haven't seen as much pass-through on tariffs. But let me answer your question. First of all, the tariff rate has been much lower than people think it is. If you take the revenues that we've gotten over the imports, it's between 8 and 9%. Point two, we are a pretty closed economy. We import 11% of GDP in goods. If you go to Europe, that's more than twice that. So that's another. So by the way, I should have presaged my comments by saying I'm not surprised by what we're seeing. So one is that the tariff rate, it's way high and way too high, and it's hugely destructive, in my view. But it's, between 8 and 9%. We don't import that much. Thus far, we've seen some front running on inventories. We've seen some margin compression, which goes the opposite way of the seller's inflation, based on, I think, the kinds of consumer responsiveness point I was making a second ago. We've also seen less foreign retaliation than we did last time. Not so much China, but I'm outside of China. We've seen less retaliation, and very importantly, we've seen financial markets not, kind of slough it off, and so that those all contribute to less inflation than you'd otherwise get. But thus far, the estimates that I believe say the tariffs have added 0.4% to inflation. Instead of being, 2.9%, inflation would be 2.5 core PCE, and that's going up to maybe, a full point. So by the end of this year, I kind of expect in core PCE inflation to be around 3%, where otherwise I think it would be closer to 2%. So they are hurting.
Mark, you write in the book that the harm from unemployment far outweighs the harm from inflation. You say by a range of 6 to 1. You say in the book, there is no direct relationship between inflation and unemployment, whereby central banks can trade off one bad against the other. You did mention at the outset that if you're a single mom working 2 jobs, inflation really hurts. Do you think the Fed should prioritize one side of its dual mandate, maximum employment, against the other, keeping prices stable? And, I mean, obviously they have they have a legal mandate to prioritize both, but they are in this situation now where they have to decide which side of the dial they need to be more concerned about. And at the moment, they seem like they're more concerned about the labor market.
Yes, but they don't actually do that, because the way that the Fed thinks about this, and this is where it has to get wonky for a minute, it goes back to this idea of R star, the natural rate of interest, and a couple of other stars, one called the output gap and another one called the NAIRU, which is kind of like structural unemployment. And they basically have a model that says, look, there's this thing called R star, and we're going to target it through monetary policy. And if we hit that, we will get maximum employment. There's no way for us to get to the employment variable without going through this route. Therefore, we focus on money. We do it through the money channel. So one gets you to the other. There really is no actual trade-off for them to manage, given the way that they tend to frame the problem themselves. So they don't try and frame it that way. But just to take this to a lot of the comments that we're seeing popping up in the chat are about the other side of this, which is wages. And wages are far too low. Now, how do we know this? I want to go back and I'm not actually a seller's inflation guy. I just wanted to give it a little bit more credence than it gets sometimes. But I will say that the following. US corporate profits historically are in the range of, when they're high, about 8% of GDP, usually about 6% of GDP. They're currently 12.5% of GDP. Right? The shift, the capital labor shift, basically the shift between what workers have and what capital owners have, is completely inverted from where it was 40 years ago. So our fundamental problem and why inflation hurts and why unemployment hurts so much is because the vast majority of people have much less than they probably should. And why is it ultimately that corporations are able to weather the inflationary storm? Because their margins could fall a heck of a long way before they actually really have to make any hard choices. And the other thing I will say about the sort of the seller's inflation point, I like to call it, well, you would if you could, wouldn't you, inflation, because, it's very opportunistic. It's not the cause, you build on it. But a lot of this has to do with market concentration. It's less to do with individual consumer elasticities. If you walk down the supermarket aisle, you've got 40 brands of cereal. It's 2 companies. Once people don't know what a box of cereal should cost, they don't have to collude very hard. When you go on airline websites, when was the last time you saw an actual difference in prices between the 4 airlines that basically control the United States airspace? And why does it cost so much to fly places, right? So these are the questions that people are asking. And I think that's actually the better way to approach it, to get away from our kind of techno wonky thing and basically say, look, where did all the money go? And why is it the vast majority of Americans don't have it?
Mhm. Well, you point to one cause when you have some very tough words for Paul Volcker, and you seem to link his inflation hammer of the 1970s, with hurting low-income individuals, but also setting back long-term wage growth.
Yeah.
You say it brought about the S&L crisis, produced Latin American crisis. What would have been the right approach in the 1970s if not what he did?
So the counterfactual is, did he need to do it? And we can't run history again, unfortunately. But I can imagine a world in which he did, but you end up with a different set. He didn't do it, but you end up with this different set of problems, which is if all of those supply shocks that Blinder points out decayed anyway and were returning in a sense to trend, you're still changing the economy in incredibly different ways in the early 1980s. First of all, you're getting rid of capital controls. And when that happens, basically, money can go out to do whatever it wants, find the highest return. That means that labor loses bargaining power. It loses hold-up power. The strikes numbers just completely decline. You have technological changes which allow global supply chaining, the IT revolution, the spread of the container ship, the rise of China. All of this is going to happen anyway. And if it had happened from a higher inflationary threshold, that might have led to different outcomes. But ultimately, all those forces, and the reason for the past 30 years we kind of forgot about inflation, is because those were many of the dominant forces that brought us low inflation. It wasn't just the wisdom of central banks and inflation targeting. It was the fact that 500 million Chinese workers joined the global labor force and wages collapsed because unions have no hold-up power anymore. So those deflationary forces would have still been there. I think that when we think about this story, we overestimate the power of central banks. And I'm very sympathetic to this because at the end of the day, they have two tools. They can raise and lower the price of money. They can buy and sell assets. And when there's a crisis, what they do is they drop it to zero and buy everything, right? And that has its own issues and so on and so forth. But they're not great tools. And if behind that, what's going on are incredibly complex process of technological change, globalization, wage deflation, why do we expect them to be wizards? It's setting them up for a fall.
Deborah, can I make a comment about this? It gets back to something you said earlier, which is, I think you were challenging Mark to say, like, let's take everything Mark just said is true, which I do, and then say, well, we can't expect the political class to do the right thing either, right? I mean, what if they get it wrong? And here I want to ask Mark, if he would, if it's okay with you, Deborah, to hold forth on price controls.
Mhm.
So price controls is something you wrote about in the book.
Yep.
You think it should be in our toolbox. Frankly, I think that there are politicians, probably even those in the White House right now, who might be more comfortable with that than we think they would. So talk a little bit about why that tool is maybe better than most people think it is, if that's your view.
Sure. So I spoke earlier about Hungary. They tried to get supermarkets to freeze prices. It was a disaster. And you can have price controls. I'll give you an example. Electricity prices are spiking all across this country because of the demand from data centers. And if you're like Rhode Island, where I live, there's no data centers. It's still going up, but it's not going up nearly as much. Actually, there are so many price controls in electricity markets. It's crazy. Now, think about the American healthcare system. How much does it cost to fix a broken leg? We have no idea. All of these prices are made up. They're completely negotiated. They have nothing to do with markets, right? So huge parts of our economy are replete with what you would call controlled prices, the price of drugs, et cetera, right? So when you get away from the scary facts on this, it turns out we do quite a lot of this. Now, the problem is before the fact, you don't know if it's going to work. And after the fact, there's a danger of misidentification. It seems to have worked, but it might be something else that's doing it. So you have to be really careful with this. And there's no real way of knowing what are very, very good controls, what are bad controls, etc., ahead of time. But that doesn't mean we shouldn't think creatively about what we need. One of the ways to think about this is we used to do this, is have buffer stocks, right? So basically you build up a strategic petroleum reserve because you don't want to be caught without it. You can imagine having a strategic chips reserve so that we don't get caught every time China turns off the chips tap, right? that would be a price control of a form, right? So again, I'm not sort of let the government decide the price of pork. That's always and everywhere a bad idea. But we actually do administer prices quite a lot already. We should just recognize it for what it is.
It's really interesting. I mean, the administration now is talking about a strategic minerals reserve. And obviously they're increasing the quotas for Argentinian beef to help bring down the price of beef. So
And help Argentina survive its experiment, yes.
but there does seem to be some, as you said, I think there is some support for a type of price control that's not necessarily what most people think of as price controls, right? There are different ways.
Exactly. And another thing about this, I mean, back in the 70s, the history of this is very interesting. They actually worked when they were mandatory. When they were brought in 71 through 73, I think it was, there was an 18-month period. Core inflation went from 8.6 down to below 2% because it was mandatory. And the mistake was, Nixon then said, seems to have solved the problem, let's make it voluntary. And both labor and business went, right, let's raise prices as far as we can. And it came rocketing back.
Wait a second. So I think the thing that we worry about is something we haven't talked about when it comes to price controls. And I'm thinking housing is a great example because a lot of people would love to see price controls, rent controls. Obviously, that's big in New York City right now with Mamdani's platform. What we worry about is screwing around with price signals such that producers will say, I'm getting out of this market and there's going to be less supply.
Totally.
I'm not saying that's always and everywhere legit, but what about that critique?
Oh, I think that's totally right. And as an example in the book of this is what happened in Scotland, where I'm from. So the government quite reasonably said, look at Edinburgh. Edinburgh is basically a tourist town. It's got a shortage of housing. It's already Airbnb'd up the wazoo. It's incredibly expensive to rent. So what should we do? Well, we should basically make it hard for landlords to boot people out in the middle of a pandemic. So they introduced legislation to safeguard tenancies, etc. What landlords immediately did was Airbnb every last thing they could find to get around that regulation, which pushed up rents by 30% and made the problem worse. This is the trying to figure out what will work beforehand, getting it wrong after there's practice, right? So yeah, absolutely. I mean, we all want more affordable housing, but part of the problem with affordable housing, and this is sort of the part of the abundance critique, which I share, is that, yeah, but it's NIMBYism, it's rules, it's planning, it's all that sort of stuff. And the fact that we don't have enough carpenters because of various reasons. So, you know, there are supply side things you could do, which would be much more healthy than controlling rents. I mean, I lived in New York in the 1990s, and I knew a couple of people that had rent-controlled apartments. They've never given them up. That landlord has never done a thing to improve the building, and the rents everywhere else in the city are still sky high. Not sure that is the fundamental answer we're looking for.
I'm going to hand it back to Dennis. I think we're at the end of the our allotted time. So, Dennis, you want to come back and wrap it up for us?
I think you're muted, Dennis. Muted.
Oh, darn. I didn't want to do it. Life did, and I did it. You know, I hate to break the discussion because I'm sure it could go on for another hour. I do want to say that I said at the beginning, this was really a great book, fascinating, a look at facts, data, and history on inflation. And at a time, in this city in particular, with facts, data, history, and analysis are being deprioritized for ideology and political reasons, I think this hour was an illustration of the importance of actually talking about facts, history, and data. And by the way, having different opinions and even disagreements, which in my view are good. And I'll tell you, one of the big problems I think at the Fed is you look at their conferences and you look at the lineup, they're all basically echoing each other now. So not only do we have the many problems and issues that you all have discussed, we have an institutional problem where people just don't want to hear what anybody says that might be different than they think and want to do from an ideological or political point of view. And I think that's a really big loss to the country, and it's hurting policy, and it's hurting the American people. And I think the Fed has to change. Change has to come from the top. The Board of Governors, every one of them has to change that. They have to stop talking to the same people and only people who agree with them, whether it's left, right, or center. I don't care. Start talking to people who don't agree. And in addition to that, most importantly, they should buy the book, read the book, And by the way, they can then watch the webinar, which we will post on the website. It's on YouTube. I can't thank Deborah, Mark, and Jared enough as I promised it was going to be a lively conversation, and it was. They delivered. So thank you very much. Appreciate it. And go to our website, www.bettermarkets.com. .org. If you want to see the webinar or get additional information on these and many other subjects. Thank you very much.